In New York City, I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live, and here's what we're watching this afternoon. Markets heading down in the final hour of trading. After December jobs flew past expectations, all three major averages on track to end the first trading week of 2024 at a loss, snapping a 9-week winning streak.
And Apple's rotten week continues. The New York Times reporting that the Justice Department is in the late stages of an antitrust investigation against the tech giant. A case could be filed as early as the first half of the year.
Peloton continuing a two-day climb, gaining after the stock added 14% in the prior session on news of a TikTok partnership. Let's get you up to speed on the market action here, and things are changing because earlier in the day we saw all three major averages in the green on the back of the jobs report. Now we have seen a rollover here heading into the afternoon with stocks more sort of bouncing between gains and losses, barely to the downside, but to the downside at the moment. So it'll sort of be a photo finish here where we end the day. It does seem to be a little more assured, however, that we are going to have a down week and break that 9-week winning streak for the S&P 500. Right now, it's consumer staples, real estate, and energy that are dragging down the major averages.
And of course, this is in part traders, investors kind of chewing over that big jobs report, making sense of the data and trying to make sense of how maybe the Fed is responding to that data. So let's dig into that a little more. It's certainly the labor market ending 2023 here on a high note, beating expectations with 216,000 jobs added in December and the unemployment rate unchanged. Let's put those latest numbers into some context. So listen, this was another good report, Julie. It was certainly a beat relative to consensus. Economy adds 216,000 jobs. Unemployment holds at 3.7%. Strong wage growth, by the way, 4.1%. And then just under the hood a little bit, just see where the gains were kind of taking place in the month. Most of the job gains, it looks like, taking place in government, 52,000, private education, health, leisure, hospitality. There were, we should know, though, some meaningful revisions, too, which is interesting. You saw that prior 2 months revised down by a net 71,000.
Yeah, let's zoom out a little bit and look at what we saw for 2023 overall as well, because there 2.7 million jobs almost added over the course of the year, the best year for job increases since 2015, if you take out the sort of wonky years of 21 and 22, the third highest gain since 2000. So that's sort of the positive spin on all of this, the wage gains that you referred to as well, not just in December, of course, but over the course of the year, giving people a little bit more spending power, although some of that was eroded by inflation, as we know. Mike Darda over at Roth MKM, though, is one of the people who is looking at the longer-term trend, and he is saying maybe things don't look as strong. So basically, he backs out healthcare and hospitality and government hiring over the look at the monthly look. And that look really does show that sharp deceleration here. And so basically what he's saying here is that we have chronic weakness in leading indicators of employment as well. And he is not terribly optimistic going into the rest of the year. He's not the only one. We have talked to some other folks who are looking for a stronger uptick in unemployment than the market is sort of implying here, including the folks over at Vanguard. They're looking for 4.8% unemployment by the end of the year.
Yeah, I mean, it was an interesting report in the sense that now markets also trying to make sense of it, or what they think the Fed makes sense of it, right? I mean, certainly you look at 2023 when we had that rip, in large part it was because the markets had decided the Fed was done. Not just done, but the cuts were coming. They were going to be aggressive, 6 cuts on the way. Now, I do think, these first few trading days of the year, maybe that is because in part, and I guess it's multifactorial, but one reason would be maybe there were investors kind of having second thoughts about that story they were telling themselves. How does this new data, how does that play into it?
The other thing that we've been talking about and that some strategists and economists have been flagging is this year the market's attention, economists' attention, is going to shift more towards jobs than inflation, right? We know the trajectory of inflation is down. Now the question is what's going to happen with jobs? This report, at least on the surface, does, Darda's comments notwithstanding, show that we are still seeing that strength in the job market.
Yeah, and Darda, very smart guy.
Indeed. We're going to talk to him, I believe, in a couple weeks. All
Also
right.
very into the Brazilian Jiu-Jitsu.
Yes,
Yeah, that's
it's
another
true.
reason I don't disagree with him.
Yes, it's dangerous. All right, for more on what the December jobs report means for investors and their money, I want to welcome in Tony Crescenzi, PIMCO market strategist and portfolio manager. Tony, happy 2024. It's great to see you. Now,
Same,
obviously,
Julie.
we've had some hours to digest this jobs report, right? And to think about what it implies potentially for the rest of the year. Do you think that this strength that we still seem to be seeing in jobs is going to make the job tougher for the Fed?
Well, Julie, as you pointed out, and Josh, there is deceleration occurring in the job story in terms of the different sectors. In fact, I would add the good sector to that. If you look at the good sector, the health, leisure, and hospitality, those sectors have been a big part of job growth over the past 6 months or so. Strip that out, and you see the rest of the economy slipping in terms of the rate of job growth. And that's important because what is happening and what PIMCO expects for 2024 is, let's say, call it 4 stages. Growth recession, that's a growth rate that's below potential, which is around 1.7, 1.8% in the United States, but above 0. So it's not an outright recession, although we think the odds are higher than market participants think. The growth recession that enables rebalancing of the labor market, the goods and services markets, in terms of the supply and demand, followed by disinflation. We're already seeing that. It's already here, especially in Europe. And then finally, interest rate cuts. And that seems to be the progression. What's missing right now from investors' minds is the idea of a growth rate slipping below potential, because that's what's needed in the end to bring about the rebalancing and the disinflation and then the rate cuts. But it does seem to be moving along those lines. And finally, Julie, I would mention today's ISM index, the services index, as you noted earlier, a little while ago, pretty weak, a figure that we haven't seen in several years, and an employment report that we haven't seen as well since the pandemic. And that's vitally important given how large the service sector is. So everything seems to be in place. We wouldn't change our view that the Federal Reserve will be cutting interest rates this year. It may, and final word is, it may on January 31st, though, be cautious about signaling that it's imminent. That's about it in terms of change, though.
And Tony, when they cut, is that because they're going to see, okay, inflation is going to return to our 2% target, it's going to stick there, and because they see the slowing economy? I mean, what are the reasons you think they're going to cut?
Hi, Josh. And I think that the important story would probably be the rise in the real interest rate. So, of course, the Federal Reserve has its policy rate, call it around 5 3/8. It's a range between 5 1/4 and 5 1/2. Stated range, 5 3/8, but the inflation rate has been falling. So in other words, the difference between the policy rate, the 5 3/8, and the inflation rate's widening, which historically means that the Federal Reserve policy is getting tighter. We should add to that, there are other factors. And the Federal Reserve Bank of San Francisco tries to measure these factors. It relates to quantitative tightening, the selling of, or letting the balance sheet runoff occur at the Fed, plus communications. Those factors combined, the 5 3/8, plus some effect or some equalization, if you will, to the funds rate from quantitative tightening might put the funds rate in the 6s, according to the San Francisco Fed. So policy is pretty tight. So Josh, the point is, again, the real interest rate is rising. Historically, even in the Volcker period, when the Fed was facing a major battle against inflation, it guided the policy rate lower, but it kept the real rate steady. In fact, if you care, it was a 5% real interest rate back then that got the job done. So that's one of the key stories here.
Well, this makes things difficult for investors, I would think, right? This is sort of a tricky period here while we're waiting. And in some of the commentary you sent us, you said you have 3 don'ts for bond investors right now. Just briefly tick through those for us.
Right. So we are often asked at PIMCO, and others are asked, what should we do? First, think of 3 things not to do. You don't want to try to time the peak in yield. Yields are higher than they've been in a while. So the Bloomberg aggregate, which is a compilation that's sort of like the S&P 500 of bonds, is close to 5%. It's above the 10, 20, and 30-year averages. So that's a good reference point. It's also high relative to expected inflation and expected volatility. So don't try to time the market. It's awfully difficult to do, even for the pros. Secondly, sure, perhaps you're worried about falling bond prices recurring, so don't catch a falling knife. But do catch these yields while you can. So what the story there is, be cautious about scaling. Be cautious about how long you get in terms of interest rate exposure. And the final one is a little confusing, perhaps. Don't fight the Fed. Don't fight the Fed in 2022 meant run for the hills. In 2023 and 2024, it should mean believing in its ability to foster price stability. And Julie, note I said price stability. I didn't say it's price objective. Price stability, defined by Paul Volcker and Alan Greenspan, the former Fed chairs, is a level where price changes, the degree of price changes that no longer has impact on household and business decision making. We may achieve price stability before that 2% objective. And the final word on the Fed is, and don't fight the Fed, is it's likely to cut its policy rate, and that's good news for investors.
And Tony, I want to get you out of here on another variable we got to consider this year because we are in an election year. And I think, Tony, part of your argument is, hey, markets could reprice when the outcome of that election is known. So is your kind of general advice then, Tony, if you're an investor, you better stay nimble in 2024?
Yeah, I think, Josh, the nimble word also should be associated with being active. One has to be active on their feet. May have to depend upon the financial advisors, big firms like PIMCO and others that have expertise in the global markets because of lots of movements, complexities related to the rewiring of the global economic system since the pandemic, complexities related to the outcome of the election, including elections, I should say, in emerging markets. Lots of things happening, complexities, et cetera. So you want to be really careful about markets this year. But again, the good news, the foundation for a good year is central bank rate cuts. But final word just came to my head. It's the idea of divergences between central bank movements. While they'll all move in the same direction, they'll move at different speeds. And so it's another reason to be active and to seek out expertise in the area of central banking.
Tony, we always love having you on the show. Thank you for your time and insight, and enjoy
Thanks
the weekend.
Thanks so much, Josh.
You got it.
You too. Take care.
The New York Times is reporting the U.S. government is nearing the end of a sweeping antitrust investigation into Apple. We're joined now by David McCabe, a reporter with the New York Times who broke the story. And David, you're keeping us busy on a Friday. Great story, David. Maybe just to start, for viewers, David, maybe just walk us through the story. What is the Justice Department focused on here, David, when it comes to Apple?
So thanks for having me. The Justice Department is in the late stages of an investigation into Apple's practices. It's been a pretty expansive investigation. And what agency officials are really focused on is the way that Apple keeps users inside its ecosystem and keeps competitors out, with the iPhone at the center.
And how is that happening? You know, what are some examples that the Justice Department might be focusing on, David? It's Julie here. Hi. In terms of what it's looking into here.
So we know that they're looking into, for example, the way that the Apple Watch, the smartwatch, works better with the iPhone than competing smartwatch brands. So if you look online, for example, you'll see that Garmin users have complained in Apple support forums about the fact that they can't necessarily reply to certain texts from their Garmin watch through their iPhone, or see certain notifications or tweak their notification status. So they're looking at things like that pair one Apple product with the iPhone. They also appear to be looking at the payments ecosystem, where Apple has built a pretty robust payments business through Apple Pay, but has not offered the same access to its payment technology or chip technology to banks and financial services firms that might want to do the same.
And David, I know I read in your story, Apple declined to comment for your piece, but you also know that Apple has made this sort of this kind of reaction, this response in the past, right? Basically saying, yes, we integrate the hardware, the services, the chips, and that's why our products work so well. That's why iPhone users are so loyal and satisfied, right?
Yeah, I mean, they say that this ecosystem is a good thing. They've said in response to past criticism that they don't run afoul of antitrust law, and they've said that the smartphone market is competitive. And so, yes, they did decline to comment, but they've made it clear before that they think that criticisms that they're anti-competitive are off base.
The European Commission has also focused on Apple, and in particular has focused on the App Store and some of the other Apple services products. When we look at that situation, can we learn anything about, for example, how Apple might react or the effect on the business?
Well, I think broadly, tech companies have pushed back fairly hard on the European efforts to regulate or police the companies. Apple is one of the companies that will have to comply with the Digital Markets Act. This is Europe's new antitrust regulation. And interestingly, one thing we reported is that the Department of Justice, the resolution of their investigation may hinge a bit on how Apple ultimately complies with that law. So, I think one thing that we know for sure is that all of these regulatory efforts around the world are sort of interlinked together in the effect that they have.
Well, David, thank you so much for joining us to run us through the story here. We will keep our eyes out for more developments coming soon. Appreciate it.
Thank you for having me.
We're just getting started here on Yahoo Finance Live. All your markets action ahead. Stay tuned.
Checking in on today's top trending tickers. Let's start out with shares of Constellation Brands rising today after reporting earnings. So stock popping in today's trade, Julie. It sounds like this is about beer sales.
Yeah.
By the way, yeah, about beer, strong. And that helped offset, it looks like, weaker kind of wine and spirits business. So specifically beer division up 4%, and that includes brands like Modelo, Especial. That was apparently a standout in the quarter. We know that import has been kind of gaining, apparently, right? Mm-hmm. So basically, meanwhile, wine and spirits, though, that was actually down about 8%. And some changes in leadership there, too, we should point out. Vice President, it looks like Robert Hansen, he kind of led the wine and spirits business there, stepping down effective February 29th. And CEO Bill Newlands steps in, at least interim responsibilities there.
Yeah, the numbers in wine are pretty lousy, right? For the full year, they're looking at, and they're on a different fiscal year. Their fiscal year ends February 29th. They say wine and spirits organic sales are going to fall 7 to 9%. Previously, they thought it would be a range of 0.5% drop to a 0.5% increase. So that's a big downgrade here, and it makes sense then that they're making that change at the top of the wine and spirits business here. They own brands like Kim Crawford, beloved of one of our producers here for what it's worth, but obviously not beloved by enough people for it to drive those numbers higher here. So it looks like that the street is happy that they are making that move, though, at the top, and obviously happy that beer is looking a little bit better for the company as well. And if you look at the comparable sales here, roughly in line with estimates, but it's really the beer thing, that the beer business that saved it.
Yeah, stock's up about 20% in the past 12 months, and the street's still bullish on this name, by the way. 22 buys, 4 holds, no sells.
All right, let's talk about another one here, Medical Properties Trust. It's falling today after the company said it would record about $350 million worth of write-downs related to some of its largest tenants that have fallen behind on the rent. Now, Medical Properties Trust is not a company we talk about every day, but it's actually the largest hospital owner in the United States. It buys the properties and then tends to lease them back to the operators of these hospitals. And like many companies within the real estate business, was very, very active when rates were low, and now the chickens are coming home to roost, so to speak, because some of its tenants are falling, or its largest tenant in particular is falling behind on its rent. At the same time, MPT is also hiring a restructuring advisor to try and figure out what to do about all of this.
Yeah, that was the news. It's basically trying to recover unpaid rents, right? Outstanding loans to one of its tenants, which reportedly here, this is Steward Healthcare System, which is dealing with some challenges. And so Medical Properties Trust decides, okay, we're going to provide you with this $60 million bridge loan. Per Bloomberg, that adds to $50 million of unpaid rent and about $250 million of transaction-specific and working capital loans owed by Steward. And a company says, listen, we're going to ultimately reduce our exposure to Steward, but no insurance. Apparently, it's going to be able to recover its claimed stock, now down about 70% in the past 12 months.
Yeah, and it's interesting when we talk about the real estate investment trust business as not being a monolith, that office is troubled, but other parts of it are not. Obviously, this is another area of weakness here with this company.
And remember about a year ago, there were some headlines flying about these guys. This short seller came out swinging, and then lawsuits started flying around here. So tough 12 months for this stock, for sure.
Yeah, definitely.
Finally, let's check out shares of Synopsys down today in a report. They are in advanced talks to acquire Ansys for around $35 billion in a stock and cash deal. So this one, apparently, again, we're going to pin this on the Wall Street Journal. They've got the story. Might come together as soon as the middle of next week. Could be about $400 per share. Talked about, we know, Julie, we actually talked about this on the show because it first started getting reported, I think, in December, right?
Yes.
Synopsys obviously makes software. It kind of helps engineers design, test chips. Big customers, by the way, for a company. NVIDIA, AMD, Intel. Yeah,
we've talked to the now CEO of the company, Sassine Ghazi, a couple of times, who took over from the founder of the company effective January 1st. And this is a company that aims to play eventually more in the AI space, but right now is pretty integral when you look at the semiconductor ecosystem because of the testing it does. Ansys, in sort of a similar business here, does testing here. And they do have a partnership that they have had since 2017. By the way, I should mention the company declined to comment on this report here. The journal, by the way, also says Cadence Design Systems had approached Ansys with an unsolicited offer, and that sort of sparked this whole situation here between the three companies. So we'll see if anything more materializes.
All right.
Well, markets falling today following that positive jobs data. For more on the latest market moves, let's go over to Jared Blickery. Jared, what happened?
Julie, it's been a really interesting day. This is the longer term movement, but let's go first to the intraday price movement. I'm going to use the futures because we did get that jobs report at 8:30 a.m. And here we saw a reaction to the downside. That was the first move. It was a bit of a fake out since then we then moved to the upside quite sharply around the opening bell, and from there, that was the high of the day, sold off into the red, and now we are about, not that far off from the unchanged, but nevertheless sinking into the red just a little bit. It looks the same on some of the other indices, and I began by showing the longer term trend. This is SPY, that's in purple. This goes back to 2020, so it shows the entire pandemic, and then we have the reaction in SPY, which is the S&P 500 ETF, and we can see it roughly tracks what the the overall market is doing. So if you had only been invested on these days, non-farm BLS days, payrolls days, this is what you would see as your P&L, your profit and loss. And this is actually where we were earlier today. That was a slight gain, but now it's in the red. I don't want to read too much into this, but you can see when we started stair-stepping down before, this actually preceded a decline in the market. And for all the talk about the market having been overbought last year, that may be something to consider here. But I want to show how indecisive the moves have been today, not only in stocks, but also in the bond market. And here's, let me see, this is a 10-year T-note yield. This is an intraday. This is what I want to show. You can see here, this is the move on the payrolls report. It moved to the upside. That was a fake out move. Then we headed into negative territory on the market open. This is when equities were open. And then we bounced to the upside. So we saw some upside, we saw some downside, but the larger term trend has been down. Is it decisively broken just yet? I don't think so. We'd have to move up quite a bit to see there, but we are in the beginning stages of potentially a turnaround. And it looks kind of similarly in the dollar. Let me find the US dollar index because we had some indecision there today. Let me just show you the intraday. We went up, then we went down, then we went back up again. And here is the 3-month trend. This is down as well, but it looks like it might be turning back up. If it does indeed, that portends future weakness probably for a lot of the stock sectors that we've been seeing. Finally, I do want to take a look at the actual stock sectors that we saw today. Financials, communication services, and consumer discretionary. 2 mega cap sectors are in the green. We know that they have not faced a lot of love or seen a lot of love this year. Plus you throw financials in there. Is this enough for a sea change? I don't think so. Here's what's been happening year to date. Healthcare, utilities, energy, financials, those are in the green, rather a defensive setup. Tech and consumer discretionary, that's retail, those are unloved. And so this is a major sea change from last year. So all the beginnings of a turnaround here. And I don't know that today's payroll report actually moves the needle in one direction or the other that much.
All right, Jared, thank you for that. Appreciate it. In the Fed's last policy meeting of 2023, policymakers said they would remain careful and data dependent in assessing policy decisions in the new year. So what does December's hotter than expected jobs report signal for the data points that will drive policy decisions in the months ahead? Joining us now to discuss is Eugenio Aliman, Raymond James chief economist. Eugenio, thank you so much for joining us. You know that the report came in certainly stronger than consensus, stronger than expected. You've had time to look over the report, Eugenio, look under the hood a bit. What do you make of it?
Yes, thank you for the invitation. Yes, the report was much stronger than what we were expecting and what markets were expecting. But if you look at the report, inside the report, I mean, not every sector of jobs is growing. So, I mean, the addition to the jobs picture is constrained to or limited to 2 or 3 very, very strong sectors, including the U.S. government, which has gone on a hiding spree for the last year or so. So they are enjoying that there's not that much competition, and they are hiring a lot of workers.
Eugenio, it's Julie here. So when we look at the bigger picture here of what the Fed is going to be doing here, is it going to be focusing now more on the job market and potential slowdown as we are seeing inflation on this sort of steady relief trajectory?
Yeah, I think that the job market is still very, very strong. I mean, on average, the U.S. economy creates 120,000 jobs over history per month. We are more than twice that, or almost twice that figure. So the jobs market is still very strong. That creates issues for the Fed because it is always the case that the job market could potentially remain too strong for inflation going forward. For now, the signals from inflation is that the disinflationary process is ongoing and will continue. But in order to get to 2% target, the Fed needs to have inflation not to be higher than 0.15 for a sustained period of time. almost a year with inflation below 0.15% per month. And we haven't been able to do that yet. I think that there potential, the probability for to do that is down the road. But I don't think that the Fed is there yet. I mean, I think that markets are running ahead of what the Fed is willing to do right now.
And Eugenio, when we talk about sort of the trajectory of inflation and how it is cooling, it's moving in the right direction. But do you see, just as an economist, some potential upside risks to inflation in the quarters ahead, Eugenio? Whether it's easing financial conditions or maybe it's the housing market recovery.
Yeah, that is the biggest issue today for the Fed. How they measure and they weight what could happen if they have a recovery in economic activity, a recovery in lending. Because remember, this past cycle wasn't a monetary cycle. It was a fiscal cycle. It was a transfer of funds or incomes from the federal government to individuals and firms. And the Fed is trying to kill a fiscal cycle by using monetary policy, which is not the right thing to do, because it wasn't monetary policy that delivered this increase in inflation. So they are trying to buy time to allow inflation to continue to go down. But there are risks. There are risks in energy prices. The geopolitics of the world are in peril. So that could push oil prices higher and gasoline prices higher, and we know how determinant these prices are for the U.S. individual and consumer. So I think that the Fed is going to go slowly but surely. I don't think that March is a good date for them to start lowering interest rates. The real federal funds rate is at about 4.1%, so it's not that high in terms of historical averages. So I think that the markets are way ahead of themselves right now.
Eugenio, thank you so much for joining the show today. We appreciate it, and have a great weekend.
Thank you. You too. Thank you.
And coming up, the latest installment of our series, you know it, Goodbye or Goodbye, as we help you navigate the best moves for your stock portfolio. Stick around.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're dipping into the energy space, oil taking a front seat as investors monitor disruptions to global supply. So what's the best way to play the space? I'm here with Dave Natick, Vetify Financial Futurist. And Dave, your buy pick has nothing to do with oil at all, at least not directly, but it does have a lot to do with the future of energy. I'm talking about uranium here, and specifically you're looking at the VanEck Uranium and Nuclear Energy ETF. NLR is the ticker for that. So let's run through your bull case on uranium here. First of all,
the global shift to nuclear.
More of a shift to nuclear that's been
that's
happening.
happening around the world, but really with a bit of a focus on the United States. We recently passed a 30% tax incentive for American companies to build new reactors. We've also got an actual direct subsidy on energy produced by nuclear that's been passed. We know those things work. That's how we got the renewables boom that we've seen in the United States. You get tax cuts on the capital, you do subsidies on the distribution. That's going to start happening in the United States. It's happening all around the world. We've got 60 reactors being built around the world. 100 more have been permitted. It's really going to be a boom era for modern Generation 4 nuclear reactors.
Interesting. And then there's also the idea that we are going to see more demand for power generally, and in your thesis, more of it's going to be coming from nuclear.
Yeah, what we know is that electricity demand in specific is going to be where the big demand crunches are. In the developed markets, that's going to be for electric vehicles, obviously. It's going to be for increased compute power, for AI. But it's also in the emerging markets, we're seeing them sort of skip some of the petroleum ladder if they can. If they can get access to cheaper nuclear energy, they can avoid having to necessarily build a coal plant that they might not otherwise. So nuclear is increasingly looking like the solution, not just in the developed markets, but in the emerging markets as well.
Yeah, and here's the global electricity production by source here. And what's interesting here is the bottom line is coal, and coal hasn't quite gone down, but it's definitely going sideways here. Nuclear here is this line right here, and this one.
Yeah, exactly. And it's stayed relatively stable as a percentage of the mix. This is actually sort of the growth stacked up. So the gap in between here is the nuclear component. That's been about 10% of global energy production, and it's been stuck there for about 30 years. That's just starting to change. That's why this is so exciting.
Okay, gotcha. And then thirdly, you're looking at the global sort of attitude, political attitude towards the alternatives to nuclear, that is older sources of power like oil and gas.
Right. We are in the middle of a boom of energy production here in the United States. That's worth saying. But what that means is prices are going to stay flat and they're going to stay stable. This is not a time to be leaning into that market. Nuclear, I think, is going to have a bit of a resurgence because it is sort of a bridge technology towards a zero carbon future.
Interesting. Okay, now we always like to talk about what's the risk to this bullish thesis. And in this case, it's expensive to build these things.
It's expensive, and also NIMBY is real. People really do fear nuclear in a way ever since the 70s that they have not feared other technologies, even though those fears are completely unfounded by the science and our experience with nuclear energy to date. So I think that's shifting. I think we have a younger generation that is more interested in solving the long-term problems, and there's no question nuclear is part of it. But never underestimate the ability of people to show up at a town meeting and say no to something.
Yeah, I mean, I have a quick sidebar question for you as well, because here we're looking at uranium, the fuel that is used in nuclear plants. Are you also bullish on, say, the plant operators, the plant constructors, et cetera?
Absolutely, and that's what this fund holds. This is uranium mine. This is from VanEck. VanEck is sort of really known for doing that equities in hard assets trade. They do that in gold, they do that in other precious metals. In this case, it's uranium miners, but it's also the power companies that are getting the majority of their revenue from nuclear. It's the technology companies that are starting to build things like fusion plants. So this is investing in the next generation of technology and the next generation of energy.
The whole suite. Okay, so that's your goodbye. Now
That's
let's talk about your goodbye, the one that you would suggest avoiding, and that's the traditional XLE. That is the spider fund that tracks the energy stocks within the oil and gas stocks, specifically in the S&P 500. So let's run through your case here. First of all, there is this assumption that when oil goes up, these companies
Right.
go
It's got to
up.
be good for Exxon, right?
Right,
We always
exactly.
think that. It tends not to actually work out that way because remember, while Exxon produces a lot of oil and sells it to other people, they also consume a lot of oil themselves because most of the majors are now completely vertically integrated. Everything from getting the drill in the ground to delivering the last drop of gas, they're in that ecosystem somewhere. And it's not the case that short-term spikes in volatility in the price of oil are good for them. Long term, of course, if oil was going to grind up to $200, there'd be lots of opportunity for some excess profits. But when we have an event like we've had over the last few months in the Middle East, when we have the kind of disruptions we've seen in South America, those things aren't good for anybody.
Let's talk about one of the other things that you're talking about. That's territorial border disputes, both in the U.S. and around the world.
Yeah, so the big one here is Venezuela and Guyana, right? Some of the most interesting and exciting reserves that have been discovered in my lifetime are on the coast between those two countries. They've been arguing about who owns that since the 1800s, and they still haven't decided. There's literally a British warship sitting in that zone right now, and 5,000 Venezuelan troops like sitting on the coastline staring at that ship. It's not getting as much press as it probably should here in the United States, but this is a real hot situation that Exxon is right in the middle of.
Yeah.
Exxon is the one that is actually doing the work in these newly discovered fields. And they're getting, one side is telling them that they have to leave within 3 months, and the other one's saying, sign a new contract with us. I think most investors don't want to have anything to do with that.
Yeah, no, it's definitely a tricky situation. Let's also talk about what the companies themselves are saying about the growth that they're expecting.
Yeah, and we've just come out of that guidance season, and you take somebody like an Exxon, the big fish in this pond, they're the ones saying that they suspect that we're going to remain oversupplied in global oil for the foreseeable future. Now, we have got a little bit of a roll-off on the growth in the U.S. Fracking rates are going to come down a little bit, but that's not like a contraction. It's just the growth is slowing a little bit. It's going to be another year or two at least before demand catches up to the oversupply. All the majors know this. They've cleaned up their balance sheets. None of these stocks look like they're about to explode, but it's really hard to make a strong growth case.
All right, let's talk about what could go right, perhaps, for these companies. And here, too, you're looking at geopolitics, right? If we see what's happening in the Middle East, if we see some more serious threats to supply there, then maybe a spike in oil prices.
And certainly I'm not hoping for any of these things, but we have seen that a sustained issue, we saw this during the Iraqi war, right? We know that a sustained geopolitical conflict will drive oil prices higher for a longer period of time. And in that case, you might see some of the super majors really ramp underneath that. I don't see that in the cards right now, but that is probably the number one risk here. Oil spikes to $120, sits there for a year. This trade is completely off.
The other thing I would ask is one of the reasons that people consistently hold energy companies is the dividend, right? That they pay these pretty significant yields. So does that suggest that at the very least there's a floor under, some of these energy
Absolutely.
companies?
I mean, these are enormous, parts of the American economy. I think of them now as sort of the new industrials, right? They're the widows and orphan stocks that people use to generate that really reliable income stream. But that's the way they're running their businesses now. So you should expect the kind of performance you get out of a big, stodgy industrial with a 3% dividend. You shouldn't be expecting big swings in response to global politics that are always in your favor.
Gotcha. All right. Well, let's sum up what you have told people here today. You're telling investors buy, if we're looking at the VanEck Uranium Plus Nuclear Energy ETF here, and avoid the Energy Select Spider Fund, in part because you see the growth prospects for the nuclear business and the sort of non-growth of what's going on in oil and gas. Just quickly, any positions either way on these guys?
Not in any of them, except I'd point out if you own the S&P 500, you've already got 6% energy exposure whether you wanted it or not.
Yes, that is indeed true. Thanks so much, Dave, for joining us on Goodbye. You can join us 3 times a week at 3:30 p.m. for more on this. And Dave, you're going to stick around because there's an ETF topic that we want to bend your ear on. So stay with us. We'll be right back. The clock is ticking down now for an SEC approval of a spot Bitcoin ETF in the U.S. in the coming days. The crypto world's going to find out whether 14 different money managers and ETF issuers will be allowed to launch their own spot Bitcoin exchange-traded funds. Here with what this will mean for crypto traders and what we can expect, Dave Natick is still with us, Verify Financial Futurist. This has really been the big topic in the ETF world for the past 6 months. I don't know, but it's obviously heated up. January 10th is the deadline we're looking at because that's when the SEC has to give some sort of answer to one issuer in particular, ARK and 21 shares. But the anticipation is we'll get an answer on all of them.
Yeah,
so
absolutely.
what is the next week, 2 weeks, month going to look like on this?
I suspect the next thing we'll see is that both the exchanges that are going to have to trade these products and the issuers will finish up their paperwork. There's a couple different forms that have to get filed. That's when we'll get a bunch of information like, what are the expense ratios going to be? We still don't know that. These things could come out free. They could come out at 2%. We have no idea. I think everybody's thinking around 50 basis points is probably the over-under on that, but we have no idea. So we'll get that when we see that from the issuers. Then we'll get the approval for these things to trade, and the SEC may or may not give a hard date there to say everybody can start trading, say, on January 21st. They may simply say, all right, everybody go, in which case we might see some of these things start trading next week. We might see a bit of a horse race to see who has their capital markets desk lined up first, and some folks may be ready at 9:30 on one trading day, and other folks may not be able to trade until noon, just because there are a lot of operational considerations in getting any ETF off the ground.
And if and when, Dave, so the SEC greenlights, this new product, what would you expect demand to look like? And where do you think, Dave, maybe the demand comes from? Do you think this is retail, it's RIAs, it's institutions?
I think initially this is pure froth, right? That's the issue. Because it is the story we've all been talking about, because Bitcoin has already had a heck of a run in the last few months, I don't think that this is going to be one of those things where we immediately have $10 billion in new assets show up. Remember, one of the funds here is Grayscale's GBTC converting. It already has $25 billion in it. So we know what that demand looks like. To me, the real question is when we look back, say, in a couple of weeks, maybe a month or two, how much incremental demand has there been over that $25 billion? Because that'll get redistributed a little bit. Grayscale won't hang on to all of that. It'll move to a BlackRock product or a VanEck product or somewhere in there. So when we add all that back up, is there a lot of demand? I think there's some. Most of the new demand will probably come from what I would consider more portfolio allocators, not traders, not folks who are just trying to take a run on Bitcoin. Those folks already know how to do that. They have lots of ways to do that. But if you're a financial advisor and you're running a model portfolio, putting a 3% slug in your aggressive version of the model, that's where I think the initial assets are going to come from.
And those financial advisors, you talk to those people
all the time.
A lot.
Yeah.
How are they making the decision of which one? Is it going to be purely, as you know, a lot of the ETF flows right now are fee-based. Is that what it's going to be? Is it that the cheapest one is going to win?
The cheapest one's certainly going to have a bit of a leg. We already know that Invesco and Galaxy are going to waive the fee for the first 6 months. That's always a little bit of a gimmick. I don't think most advisors get sucked into those kinds of fee waivers. If one of the big players, the big known names, say like a BlackRock or a Fidelity or somebody, comes out with the cheapest one, I think that's tough to compete against. But interestingly, I think it's where the volume is in the first couple of weeks that matters more than the cost.
So in that case, it does matter who starts trading first.
It can, because if we get a big slug of volume and then the derivatives market shows up and all of a sudden we have a live options market on that particular ticker, that's very hard to ever upset. So we've seen this before with things like gold. GLD finally started trading options. You could come out with the cheapest, best gold product in the world. You'll never pry GLD out of that derivatives ecosystem.
Do we know that there is going to be an options market automatically? Like if the SEC approves it, do they approve it all? Is there then options?
So then
is
it
free
would
game?
go to the actual options dealers to decide effectively when they want to do this. Now, when GLD got options, there was a bit of a hiccup there about how it was going to be cleared, et cetera. I have a feeling those conversations have long since happened already. Everybody understands that the options market on this is going to be enormously valuable and enormously powerful. I mean, you guys have talked about it a ton of times. People trading zero-date expiration options is almost replacing people trading stocks in some cases. I think you're going to see something very similar happen here with Bitcoin. I suspect we'll have a good, clean options chain with real volume on it within weeks on the outside, and possibly within days if somebody's done a lot of pre-planning.
Wow. Cool.
Dave, thank you so much for being on the show today. That was great insight. Appreciate it.
Thanks for having me.
Meanwhile, if you have not heard of the AI startup Perplexity, you could be forgiven, as they only launched in 2022. But since then, they have been valued at $520 million, have raised huge amounts in funding so far, with some big names backing them, including Amazon's founder Jeff Bezos and the semiconductor giant NVIDIA. Perplexity announced its latest round of Series B funding yesterday, and their CEO, Arvind Srinivas, joins us now. Arvind, thank you so much for joining us. And maybe just start there, Arvind. Maybe for our viewers, explain a little bit about your company, the product, and what's the problem you're trying to solve for in search.
Thank you for having me here. So Perplexity is a conversational answer engine. By that, it directly answers any question you ask and provides you appropriate references in the form of citations. We are trying to reimagine the future of search by taking you all from consuming 10 blue links to anything you ask on the typical search engine, to directly just getting a clear, personalized answer, cutting through all the noise on the web and saving you a ton of time.
So it's a really intriguing concept, Arvind, and it's one that you're not the only ones working on a version of this, right? So can you explain to us what the difference is between a Perplexity and a Bard, for example, or some of the other generative AI-powered search engines that are being developed right now?
Yeah, 100%. So there are a lot of AI chatbots right now, and you can think about AI chatbots as like three types of use cases. One is these useful content generation kind of chatbots. Like, for example, you go to it for writing an essay or writing a piece of code or giving you ideas for, baby names and things like that. And then there's the other use case of talking to imaginary characters, personalities. And then the third use case, which is accurately using information and just giving you accurate answers to questions, like factual accuracy-based use cases. So we are focused on the third use case. Bard and ChatGPT are trying to build one chatbot that can do both the first, which is free-form content generation and answering questions together, but we are only focused on factual accuracy and relevance. So almost like a vertical of AI is search, and which is a huge vertical, because there are so many verticals within search that might make search itself look horizontal. But then from the perspective of an AI chatbot, having a chatbot that only uses web information to answer your questions and nothing else is a very focused version of the chatbot, and that's what we are working on.
And Arvind, you're going after a giant here, of course, Google, which controls, Arvind, 90% of the online search market, big company, deep pockets, smart engineers. And of course, Arvind, they're aware of this AI trend, right? They're building AI products as well. It sounds like a tough fight, Arvind.
It may sound like that, but the reality is our strength is their weakness. For example, they are working on a free-form chatbot in the form of a product called Bard, but they are never going to change the core google.com from 10 blue links to something else dramatically. It's not going to happen tomorrow, or it's not even going to happen the next month or next 6 months or a year, because that's a $1 trillion market cap built around that particular user interface, where people are bidding on how many times a link got viewed by 1,000 people or how many times a link got clicked. So that user interface is so hard for them to change, because the whole company's destiny relies on it. And when you are disrupting that user experience and user interface by just giving people the answers and removing the need to actually go and click on links and sift through the content, you're actually playing to their weakness, right? So that's why we think we have an opportunity here. It's the classic innovator dilemma.
Arvind, the way you guys operate, people who use this right now have to pay a monthly fee, I believe, if I'm not mistaken. That's right. And so you have millions of people now that have signed up for this. What's the plan of the company for where you go from here? Is it just a matter of trying to sign up as many people as you can? And how big do you think that market is? How many people are willing to pay for this service?
Just to add a caveat there,
yes.
You can sign up, create an account. You don't have, or you can even use the product without creating an account, the product is available for free as well. If you want to be a paying user, you get access to more cutting edge AI and more unlimited uses of our, Copilot that, as you show here, asks you clarifying questions and goes much deeper in research. So a large fraction of the users are free users, and some of them are paying users. And we don't believe this is the end of our monetization plans. This is the beginning, subscriptions. And we think there's going to be a lot more creative ways to monetize this. But the more important thing is to actually grow in usage. And that's why we raised this funding round to expand our consumer adoption.
Arvind Srinivas, really fascinating stuff. Let's keep in touch as you guys keep growing. Appreciate it.
Thank you so much.
Coming up, we've got the closing bell on Wall Street. We'll check in on the latest market moves and the top trending tickers. Stay tuned. Got the closing bell on Wall Street, so let's do a check of the markets here and figure out where we ended things after what was kind of a tumultuous session here. A lot of bouncing between gains and losses, but it looks like when all is said and done, we're going to finish in the up column here for the major averages. The Dow finishing the session up by about 25 points here. The S&P 500 up by, call it 0.2%, and the Nasdaq up just marginally here by 0.1% here. But, you know, it really was kind of a volatile session as people kind of tried to digest what was going on here with that jobs report and what the implications are. And they were also trying to digest on the week. So let's talk about what we have seen on the week thus far. That is year to date, is another way to put it here, I guess. We saw a snapping of the winning streak for the major averages. So if you take a look at the Wi-Fi Interactive, I've pulled up the year to date chart of the Dow. Down about 0.6% on the week. The S&P 500 down 1.5%. But it's really the Nasdaq where we have seen the big losses here. The Nasdaq down 3.25% here just in the beginning of the year. And indeed, the year thus far, I mean, I know you were cautioning yesterday, and rightly so. We shouldn't extrapolate too much from just a few days, but it is notable.
It's a good theme.
Yes,
yeah, I mean, certainly, like, talk about tech, we can talk about Apple for a second, too. That was certainly a theme this week. You know, we don't want to overstate it. Most of the street is still bullish. I think 60% of analysts. But that was a theme this week. Piper downgrade, Barclays downgrade. We just heard the New York Times story. Of course, we had that reporter on. So that's an interesting theme. I think, you know, as you see this kind of churn in the beginning of the year, and there's different reasons for that. I mean, one is, as we were discussing, I think maybe there are some investors who are having second guesses now about the Fed, and really will it be 6 cuts? I think there's others, you know, another interesting thing to watch as we get closer to earnings season. I do kind of wonder whether China is creeping in. China is shaky, and what that kind of means for corporate profits, both what we're going to hear in the next few weeks, but also when CEOs start talking about the outlook. Such an important end market for so many different companies. I think that'll be fascinating. And then you hear sentiment too, right? I mean, there's plenty of bulls who say, you know what, even for us, it's looking kind of crowded. Yeah,
look at the Wi-Fi Interactive again. Apple down 6% just in the first few days of the year. If you pull that back and look at a 1-month view here, you can see even more starkly that drop off that we saw for those shares. And then taking a look at the Nasdaq 100 year to date here, so to speak. NVIDIA not down much, only 0.9%. Meta only off 0.5%, but Amazon down 4%, Tesla down 4%, Microsoft and Google each down between 2 and 3%. So again, gives you a flavor for the rotation that we are seeing, at least in the early days. And speaking of which, let's also take a quick look at the sectors here. The XLK, information technology, down the most. Consumer discretionary, though, down second most. And then you've got healthcare, the XLV up the most, 2% as we kick off the year here.
Yeah. All right, big themes to watch there.
Yeah.
Meanwhile, let's get a check of some trending tickers in today's trade. Shares of Palantir taking a hit today after Jefferies downgrades that name and saying the AI hype around the company is overblown. Their analyst, Brent Thill, told Yahoo Finance today that although the company still has an AI advantage in the long term, its valuation has become unsustainable.
We are huge fans of what's going to happen due to AI. But again, as we said, that the hype is ahead of the reality. And we think, again, the stock, given the magnitude of the outperformance last year, we simply just like other names in software, like Monday.com, Microsoft. There's a handful of others that we like better.
So a new Palantir bear here, Brent Thill over Jefferies, says, yes, he says, I mean, it's interesting when you read the note, he's still a fan of the company. I think it's partly the run he's saying here. He just thinks they have an AI technology advantage in the long term. He's saying he's concerned that stock has just rallied to these unsustainable valuation levels on the back of what he says is AI euphoria. And also, by the way, he mentions retail trading momentum. And yes, this stock has been an absolute monster, ripped over the past 12 months.
Yeah, I mean, let's take a step back here. If you're looking at 2024 and you're saying to yourself, I want to play AI, how am I going to do it? Let's say you have no position.
Yeah.
He's saying there are better places to go. If you're in the stock already, he's saying, we like it long term. And by the way, another person who really likes it now, long term, you know, he's one who's prone to big statements, and that's Dan Ives over at Wedbush. We just spoke to him yesterday, and he said Palantir is the best pure play for AI.
Everyone focused on government, what they've done there, maybe some of the controversies. The reality is that they've leveraged that government expertise into enterprise. You look at AI.
So you see the commercial just keep on growing.
Right now, you don't see a major AI deployment where Microsoft, Palantir are not at least tip of the tongue in terms of some of these use cases. And that's our view. Our view is some will say Palantir is expensive, it's hype. This year they prove it. And I think that's the key as this all plays out for what I continue to view as stock that could ultimately double over the next 12 to 18 months.
So obviously we got to get Dan and Brent in here, get a little,
that's a good
little
fight.
back and forth.
Although I'll tell you, Brent's going to have to step up the wardrobe game. he can't come. I mean, Brent Till knows he can't come with just the Patagonia against that kind of jacket.
I don't know. Maybe he's got the confidence.
Maybe he does the understated thing.
Yeah,
and I respect that.
So.
I do.
Yes,
I do.
There's something to be said for that. So we'll see which one of them is right about Palantir when the year is said and done. Another stock that we are watching closely here is Fisker, and this is one we've been watching. It has plummeting to a record low today, down by 9%. There's some new lawsuits being filed that have to do with securities law violations, have to do with the plunge that we have seen in the stock. Investors who have lost money are being encouraged to make attempts to recover losses. This is something that happens not infrequently when you get plunges like this. You get various lawsuits being filed. But if you look at the background here, the stock down 80% over the past 12 months, and really the losses accelerating after the report of its third quarter earnings. At that time, it also said it found material weaknesses in its internal controls over its financial reporting. It's had some various chief accounting officers turnover at the company, and so all of that has resulted in this drop in the shares.
Yeah, I mean, in the lawsuit was just the latest headline and not what this EV startup needed, because as you said, it's already, the stock's just a mess. It's down 80% in 12 months. Oftentimes you see that kind of shelling, maybe some people move in, but I'm just looking here. If you look at the analysts who cover it, in fact, you have 5 sells, four holds, and 3 buys. So there doesn't seem to be a lot of optimism, even among the financial analysts who study this stock and are paid to give you advice. Not a lot of optimism. It's going to see better times ahead. The stock's now trading under $2.
Yeah.
And meanwhile, let's get a final one. Shares of Marvell leaning to the upside after the company met with JP Morgan today. Analysts from the bank said that the AI revenues of the semiconductor company are tracking significantly ahead of prior expectations. So this is an interesting one, Julie. Basically, JP Morgan, listen, they're overweight. So in other words, they have a buy. And bottom line, they spoke with Marvell's CEO, Matt Murphy, liked what they heard, clearly telling their clients that after that meeting, they're seeing AI demand and the pipeline and revenue visibility just continues, in their words, to expand. It's tracking ahead of expectations from just a couple quarters ago.
Yeah, and they also said that the company has a diversified set of products in its data center business, which accounts for about 50% of sales. Data center, they say, is strong here as they're looking at AI also as it feeds into that. To your point there, Marvell, one of the stocks that definitely participated in the chip rally last year. The shares were up by 63% last year. And despite the sort of declines we've seen in recent days among some of the chip makers, Marvell is actually up for not just today, but was up yesterday as well. So again, this sort of theme of, okay, I'm looking at this year, who's going to benefit in AI? Where am I going to put my money? It feels like a lot of folks are making that assessment right now and trying to figure that out.
Yeah, Marvell, tremendous last 12 months and a lot of love on the street, for sure. Okay, moving on. Many unanswered questions we know surrounding investors going into 2024. Our next guest thinks that the when and why will rate cuts begin is one of the most important. For a deeper look at how to invest in 2024, we're talking to Mark Dysart, PNC Asset Management Group Chief Investment Strategist. Mark, thank you for joining us. I want to start with the big economic data point today, Mark, that big jobs report. Get your take on that, and importantly, how you think the Fed thinks about that big jobs report.
Yeah, Josh, appreciate you having me on in the first place. I think the jobs report's really actually in line with the outlook that you described, with so many unanswered questions coming into it. There's still more questions than answers, but it's hard to say. I mean, when you get a report like we did this morning, 216,000 jobs created, it's hard to dispute the strength of the labor market. It is obviously still strong. The thing that I think probably went on under the radar for a lot of people is the revisions, though. So we saw October revised down sharply, November revised down sharply. So it's strong, but you're still seeing a little bit of softening here within the labor market.
And so, Mark, it's Julie here. Does that make it a Goldilocks kind of report for the market? I mean, the market didn't really react that way, but is it sort of enough weakness and enough strength that it doesn't sort of jeopardize what the Fed is trying to do here?
Yeah, Julie, I think it's a continuation really from what we saw last year, and we're getting mixed data. But when I think through, if I were sitting at the Fed, how would I interpret this? I'm thinking through that this is a pretty good report, which I think is the way that you saw the market react to, right? It wasn't a really strong reaction. You saw some ups and downs through the day, but it was a pretty good report because obviously the strength of the labor market, but I think it supports the monetary policy decisions here, right? They haven't, in their view, this report doesn't say we've gone too far, but at the same time, it doesn't say, right, it's immediately time to pull it back right now. So it is a little bit of that Goldilocks component. I think it is what they wanted to see as far as the labor market, again, with a little bit of that softening from prior months, but still a strong report and strong labor market.
And Mark, so we got another big event on your calendar as a strategist. Earnings season is kicking off here. I'm interested in what you think we're going to hear. Is it a potential catalyst for the market, Mark?
Yeah. So coming off of last year, obviously, I'll say we broke the earnings recession because we had a few quarters there where it was negative earnings growth. Obviously, with last earnings season, we broke that. I'll say positive 5%, rounding a little bit there on earnings growth. But I think we're going to see a continuation, especially into this season here, wrapping up the Q4, right, heading into that earnings season. I think we're going to see a continuation. So what do I mean by that? If you take out, everyone's beloved Magnificent Seven stocks, third quarter earnings results were actually negative. I think we're going to see some of that same masking into this earnings season here. So expectations coming into it from a market perspective, it's going to be positive. So overall, we'll see that positive earnings growth. But again, I think if we strip out just those 7 names, we're going to see actually negative earnings growth. So we're going to be in that same kind of state where you have a few bellwethers that are really carrying sentiment, carrying the market, covering up, I'll say, in some ways, maybe some weak points. Really, as I think of the entire 2024, if we are going to see the market rally higher, if we're going to see a continuation of, what we enjoyed in November, December, we're going to have to see it broaden out. I'll say to the other 493 names, it's going to have to be a broader earnings recovery, not just covered up by just a few names, turning everything to look positive on the headline.
Well, Mark, you sound a little cautious here. So if you're looking at whether that's going to happen or not, do you position yourself defensively or at least hedge when it comes to your equity positioning?
Yeah, I wouldn't say hedge, but we are running, I'll say, a slightly defensive playbook. So when I think of, how to allocate portfolios right now, this isn't the moment in time that we're thinking that cash is a huge investment. We want to remain fully invested, but we do like diversified portfolios. We with the uncertainties, whether it be the Fed, inflation, labor, U.S. consumer, when rate cuts and why rate cuts are going to happen. When we look at that mix of uncertain data, right now, it just doesn't seem like asymmetric risks are the ones that are going to pay off. So we want to remain fully invested. We want to remain diversified. When we think of the earnings for the entire year, right now, the market expectation is about 11.5% earnings growth. They're expecting 6 rate cuts, possibly in 2024. That all sounds a little optimistic, especially when we're pushing around 20 times price to earnings multiples. So it is a little bit cautious, I'll say slightly defensive. To us, that looks like large cap over small cap. That means having quality exposures built in, being very valuation minded. So that means maybe not chasing just the things that have done well, but paying attention to the underlying earnings and seeing what is recovering and maybe catching some of that momentum as things kind of catch up to everything else that ran last year.
Mark, thanks so much. Really appreciate your insight today.
Really appreciate it. Thanks for having me.
Take care. Well, weight loss drugs like Ozempic have taken the nation by storm. While millions of people want the drug, who ends up footing the bill? Yahoo Finance's Madison Mills here with more. So Maddie, insurance companies, individuals, how's it going to work?
Well, in this case, we're going to focus on the cost to the state. And the state obviously pays for health care in a variety of ways, right? Medicare, Medicaid, state-employed workers. But specifically looking at Medicaid, Bloomberg crunched the numbers here. And the numbers are pretty staggering. Remember that these drugs are $1,000 per year per user. If you look at the increased cost just to states year over year, you're looking at a doubling from 2021 to 2022. And that 2022 headline number is $7.9 billion. Again, just in costs for GLP-1s. And you can see that increase in this chart on the screen here from 2020 up to 2022. And some pre-reporting tells us that we already know this number is going to be even higher heading into 2024 here. And my big question here is that the demand is so huge. How are they ever going to bring these costs down? We had Eli Lilly saying that, this is not a drug that's meant to be used for cosmetic purposes. Novo Nordisk really focusing on diabetes patients first. But if their tune starts to change a little bit on that and we see even more demand for these drugs, how do you bring those prices down?
And May, what are drug companies saying about the costs that these individual states are taking on here?
So their argument is that the increased use of GLP-1s will lead to health increases, increased health for a variety of other health challenges that people might have, which is a very challenging thing to measure the data on, right? So the Congressional Budget Office has already commented on this, saying that it's not necessarily clear in the data that if you see an uptick in GLP-1 usage, you're going to see a downtick in other health-related challenges. And also we're seeing that Eli Lilly is funding some of the research surrounding health increases due to GLP-1 uptick. So you got to be careful with the research that you're looking at in terms of the health impact of these drugs.
It was a big story last year. It's going to be a big story this year for sure. Madison, thank you so much. Appreciate it. And coming up, stay tuned for Yahoo Finance. More after the break.
Oil prices on the rise as volatility continues to take hold of the sector. Here with what's behind the latest price action, what may be ahead for oil. Let's get to Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Julie, and oil finished the week in the green. You've got WTI and Brent crude that today were up more than 2%. Oil has had a kind of volatile week. We saw prices that were lower yesterday. That was because of a disruption at a major oil field in Libya. There's been concerns also about the Red Sea and Houthi attacks in the Red Sea, and Iran, which backs the Houthis, and Iran sending a war vessel into the Red Sea. The concerns among traders, not so much about that war vessel, more about what will happen if there is a disruption in Iranian oil, which is Iran produces almost 2 million barrels per day of oil. Look, as far as prices are concerned, mid-January, you do see prices that are more sluggish. This is partly seasonal, but of course, we also have had concerns in the markets of oversupply and also OPEC maybe not having as much influence or power over its members to adhere to their quotas when it comes to production cuts. So OPEC wants production cuts, and then there are non-OPEC members like the U.S. that are producing more oil. So as OPEC members are shrinking in market share, you've got other players in the marketplace that are increasing their market share. And more analysts are right now reiterating their target for the year for oil. You've got B of A that just put out a note saying that they are reiterating $80 a barrel for oil as an average for this year. They don't underestimate Saudi Arabia's target to put oil at a higher level, but nonetheless, we'll see where it takes us. But the range is that oil is going to stay around this range among the analysts. That's a consensus.
And yes, shifting to the natural gas arena as well here, Southwestern and Chesapeake reportedly near a merger here. What's the latest with that story?
Yeah, that's right. This is from a report from the Wall Street Journal that this deal could be announced as soon as next week. These are two companies, one with a market cap of $7 billion, the other one with $10 billion. So combined, this would be a combined company of a $17 billion market cap. This would rank as one of the largest natural gas producers in the U.S. And Chesapeake's focus on natural gas would be more laser focused now if they do merge with Southwestern. And look, I've talked to analysts that have been telling me natural gas is oversold. We have seen the price of natural gas go down considerably, but the market doesn't expect the prices to keep at these levels, especially when you talk about liquefied natural gas. The U.S. has been exporting more of that to Europe and to other places. And when we talk also about the electrification, the green energy, I spoke to one analyst that was telling me, look, you still need energy, and natural gas is seen as one of the cleaner fossils out there when it comes to that transition, using that to get to the greener energy space.
And yes, thanks so much. Enjoy the weekend.
You too.
Diversified Energy is attempting to pave the way for the future of natural gas companies by taking a unique approach to their production. Rather than drilling new wells, they buy existing ones and invest in them to improve production, reduce emissions. The company began trading on the New York Stock Exchange on the ticker DEC in December. We're joined now by the co-founder and CEO, Rusty Hutson Jr. Rusty, thank you so much for joining us today. And I thought, Rusty, we would start just with your business model, because as I understand it, Rusty, it is a bit different. What you all specialize in, as I understand it, Rusty, is really kind of moving to those relatively older, minimally productive wells. Is that accurate?
Well, I would call it mature producing wells with low declines and long life, tail left still on the production profile. But it's a different model. It's different than the traditional E&P models that are drilling and completing wells every day. What we look to do is to acquire wells from those types of companies that are looking to drill more and reinvest capital into the drill bit, and we're buying the tail of those assets, enhancing production, doing it more efficiently, driving cash flows, and returning some of that cash back to our shareholders.
And Rusty, you are there at the New York Stock Exchange, obviously, because you guys changed your listing, if I understand it correctly, or maybe now you're dual listed in New York and in the UK. Can you talk us behind the sort of process of doing that and the rationale behind being listed in Britain in the first place and domiciled there, if I'm not mistaken, and then the listing here as well?
Yeah, so we listed in the UK back in 2017. Back at that point in time, the company was smaller. We accessed capital through the London Stock Exchange through AIM, $50 million IPO. But really what it allowed us to do over the last 7 years was access a pool of capital that wouldn't have been available to us because of the size of the company here in the US. And so we were able to access capital that helped us to grow the company substantially over that period of time that now allowed us to dual list here on the New York Stock Exchange back in December.
And Rusty, while I have you, I got to ask you about these headlines, these reports. We saw, Rusty, that House Democrats, from what I'm reading, they opened an inquiry into the company. And it sounded like, Rusty, the concern among some was just your well retirement and emissions practices at these more mature wells that you all focus on. What is the story there, Rusty?
Yeah, we received the letter. We obviously have been reviewing it and crafting our response, which we take as an opportunity, really. I mean, we think that being able to respond and tell the story of what we do from an emissions reduction perspective on a daily basis, and all the capital that we deploy to not only identify but to reduce and eliminate emissions within our portfolio. We also have the largest asset retirement company in the Appalachian Basin. We're retiring more wells on an annual basis than anybody else, not only for ourselves, but for the states through their orphan well programs that we bid on their work. So we have a great story. We'll respond in a way that we've responded in the past to these same types of questions, but we think it's a big opportunity to let our constituents and the people read and understand exactly what we do and why we're the right company at the right time to manage these wells.
And Rusty, I want to get you out of here on your take on just the natural gas market. You look at natural gas prices, Rusty, obviously you have unique insight there. Where do you think they're headed in the near to the intermediate term here?
Well, I think it's oversold a little bit right now, obviously. The weather hasn't picked up. We're starting to see some weather creep in. I think we'll see some recovery in gas prices. I really see over the next 12 to 18 months a $3 to $3.50 natural gas price that will transpire and really stay intact over that period of time. Over 25 and 26, I think it's going to get really good because the capacity that's coming online on the LNG facilities in the Gulf Coast is going to pick up demand substantially and double the amount of gas that we're going to be exporting on an annual basis. That's going to be a big demand that's going to have a supply that's going to be needed that we don't have today.
Rusty Hutson, thank you so much. Appreciate your time today.
Thank you very much.
Well, shares of Peloton sustained a second day of gains after announcing its partnership with TikTok. We'll talk to a couple analysts about the at-home workout company on the other side. Shares of Peloton have sustained a second day of gains after announcing its partnership with TikTok. The fitness network will create a fitness hub on the social media app as it tries to reach new potential customers. With insights on how this move might pan out for Peloton, we have Brian Nagel, Oppenheimer Managing Director and Senior Analyst, along with Shweta Kajuria, Evercore ISI Managing Director. Shweta, I want to start with you here on your read on this latest move. At this point, Peloton might need some help, one could argue. Is this going to move the needle for them?
Well, first of all, thanks for having me. And no, to answer your question, I don't think that this is a needle-moving move. To Peloton's credit, I think that it is a good marketing investment for them. Essentially, they are partnering with TikTok. They're spending on content. It's just analogous to marketing on TikTok to the 1 billion viewers that TikTok has. And so to expect an meaningful incremental impact on Peloton's P&L from this partnership in the near term, I think would be aggressive. I think what may be better for them is an improvement in brand perception through this partnership. And that eventually could lead to Peloton app downloads, which could lead to engagement, which could lead to subscribers. But that may not be a near-term impact.
And Brian, I just want to get your reaction. Do you agree with that? Maybe a partnership not going to be an especially big, meaningful new revenue driver, at least in the near intermediate term here?
No, yeah, I largely agree with that. I mean, we had a similar announcement from Peloton not that long ago with Lululemon. And I would answer that question the same way with Lululemon. But look, I think what's happening here, and I think this is the positive. It's not game changing, but we're getting a better idea, I think, of where this Peloton business model may be heading. Okay, and it wasn't that long ago that Peloton was was viewed as a hardware company. Its primary business was selling its bikes with its content to people in their homes. But now we're seeing, I think Peloton is telling us or directing us as investors that this is going to be more of a content company. Now, where that ultimately goes is tough to say. I don't think today's announcement is game changing. I don't think the Lululemon announcement is game changing. But again, we're getting an idea of where this Peloton business model is possibly heading.
Well, and then, of course, the question is, Shweta, what that's worth, right? What this content company with sort of a side of hardware is worth. The stock is down for 3 straight years now. We know it's down sharply from its highs it reached in late 2020. So what's the value of Peloton?
Well, that is a great question. Currently trading at around 2.5 to 3 times subscription gross profit, I would argue that it is a rich multiple by any stretch. And so I do think that Peloton remains a takeout candidate for a company like an Apple or an Amazon or a Nike or whoever the speculation was being circulated a couple of years ago. It still holds true. In fact, the stock is even cheaper. So I'm going to refrain myself from commenting on any speculation, but that does hold true. In terms of the potential, I guess the biggest question is, can Peloton as a company, while it is trying to transition from a hardware first to a software first company, can the company manage itself to be an independently self-generating, positive free cash flow generating company, and at the same time show top line growth? That's a very difficult balance to maintain in the mid to long term, and the jury's still out on that one, and that's why the depressed multiples.
And Brian, I want to get your take there as well. I mean, you're a believer, Brian. You got to outperform on this name. Is part of your thesis, Brian, that this is an acquisition target, a takeout target there? Because listen, you hear that talk a lot, and even recently I've heard some smart analysts, Brian, saying, yes, they think it's a target. Yes, they think maybe it's Apple could move in there because they think perhaps Peloton is a good fit given Apple's focus on health and fitness.
Yeah, so let me make sure this is exactly how we answer this question to our clients. When you say I do have an outperform on Peloton, I have a $20 price target. Okay, but the wager I am making here, and first I want to make the point, this is highly speculative. I follow a lot of names, much bigger, more stable names, which I have far less speculative recommendations on. I mean, Peloton is highly speculative, but in my recommendation of this stock, in my price target, I'm basically saying that I believe that Peloton will survive. And I know that's not the boldest of calls, but I think right now, even with the move up in the stock for the last couple of days, I think there's still a great deal of skepticism as to whether Peloton survives. I believe it survives. And then going back to the prior question, I mean, I think these steps, while not monumental, while not game changing, I think are moving us towards that survivability of Peloton. Now, where we go from there, it's tough to say. I have not factored specifically into my recommendation or my price target a takeout. I do view that. I mean, I watch Peloton very closely. I think there was always the potential for it to be taken out. That's not something I factored into my rating and my price target for the stock.
Okay, so Brian, all of that said, surviving and thriving are obviously two different things. What do you think the growth prospects are like for Peloton, right? If it's just surviving?
Well, I mean, the way I'll say it, I mean, I think survival is the first step. Okay, and I don't think we've answered that question yet. I think we're getting closer to it, but I think we need to survive first. Okay, after that, then we decide where this grows to. Now, look, if I can paint a pretty rosy picture that Peloton over longer term, particularly if it becomes much more content and hardware focused, has a big growth potential ahead of it because it's opened up a much larger addressable market. It's a much larger TAM, if you will. But again, as I think about Peloton right now, I think the first thing we've got to do is basically get comfortable if this company is going to survive. It's, till recently, it's still been burning a lot of capital. So it's not yet, in my mind, capital self-sufficient. But I think we're getting closer to that step.
And Shweta, I'm going to end here with you. Now, your take on this stock a bit different here. You're in line, I believe, Shweta, so equivalent of a hold. What would you need to see, Shweta, to get more bullish on the name?
Well, I would like to see more conviction on the company's ability to deliver positive free cash flow. I think that knowing the management team, that is their number one priority. So my best estimate is that they will exit the year at break even. But what I'm not confident in is whether the company will be able to deliver on top line growth while also managing its costs and generating positive free cash flow. So one of the leading indicators that I would be looking for is if actually the engagement on their app, and if the engagement just on the Peloton platforms does improve, and that would be a pretty good indicator for whether the subscription business is going to continue to thrive. And I don't see that just yet.
Brian and Shweta, thank you both so much for joining us today. Appreciate your insight on this stock. Appreciate it.
Thank you.
Thanks for having me.
Shares of McDonald's and Papa John's have taken a tumble today on low expectations on the year from analysts and warnings that the conflict in the Middle East is affecting sales and brand perception. Oppenheimer has downgraded both of the big restaurant chains, citing same-store sales as the main driver. Yahoo Finance's Brooke DePalma is here with more. Brooke.
That's right. Quite a different story from 2023. McDonald's was actually in Oppenheimer's top ideas of 2023. Now Oppenheimer downgrading shares of McDonald's from outperform to perform. The firm anticipates a tougher setup for same-store sales growth in 2024, particularly here in the U.S., where that 10% of pricing is already baked in to 2023 full-year same-store sales growth. Oppenheimer also expects negative traffic among low-income consumers, and we did hear in the latest quarterly earnings results that the company is seeing pressure among low-income customers, particularly those that make $45,000 and under. Oppenheimer also citing expansion plans that are expected to reach 50,000 units by 2027. Well, that's no longer a stock catalyst, which Wall Street has been largely weighing on. Shares of McDonald's down roughly 1% today, and shares of Papa John, well, they downgraded shares of Papa John's to perform. They cited a tough environment for Papa John's to unlock same-store sales growth as well in 2024. They also cited concerns to earnings growth based upon those 118 UK stores that they purchased from franchisees and converted to company-owned stores. They're also citing international growth could be pressured by geopolitical concerns, which Papa John's CEO did say to Yahoo Finance earlier, or rather late last year, among other factors that could weigh on expansion. They did end the day down 4%, and shares of Papa John's are down 9.6% so far this year.
Yeah, so give us a little more detail on that geopolitical piece that you just mentioned here. What kind of presence do these companies have in the Mideast, for example, where there is still a war going on, and what effect could that have?
Yeah, well, to jump off, Papa John's CEO once again did say that there are development concerns in the Middle East based upon the war that is currently happening there. And in addition to that, McDonald's CEO Chris Kempczinski kicking off the year weighing in on these concerns in a post on LinkedIn. He also weighed on misinformation. In the letter, he said, quote, several markets in the Middle East and some outside the region are experiencing a meaningful business impact due to the war and associated misinformation that is affecting brands like McDonald's. He called it both disheartening and ill-founded. Now, in late 2023, in December, Starbucks CEO came out with a similar message in a memo to its employees. He said that they're concerned about the state that we live in. He also noted with conflicts in many parts that have unleashed violence and sparked protests. He said it's largely influenced by similar messages. He said misrepresentation on social media and what they have stood for has ultimately led to vandalism in their stores. And so it'll be interesting to watch how this all plays out. If we'll hear from more executives as we make way towards earnings about how much of misinformation and these tensions in the Middle East weigh on development as well as overall perception of the companies.
Yeah, it's interesting. It's not something that you would necessarily think off the bat.
That executives would.
And these types of companies would be affected by these issues. You think oil and gas, you think of some others more.
Right.
So that's a good flag. Thanks, Brooke. Appreciate it. Coming up, what to do with your jobs retirement plan, if any. We'll help break down your options on the other side. If you're starting a new job in the new year, congratulations, but you may be taking a look at your old employer's retirement plan and wondering what, if anything, you should do with it. Here with us now to break down your options, Yahoo Finance reporter Carrie Hannon. So do you roll it over? Do you keep it what it is? What do you do?
Well, you should do something. Now, essentially, what happens is you have four choices. And the number one choice is to cash it out. Right now, this is not the plan. This is not what people should do, but it's so tempting when you don't have a big account, right? But if you cash it out before you're 59 and a half, you're going to pay a 10% penalty and income tax on that. So that's clearly something that we encourage people not to do. The second thing you can do is do nothing and just leave it stay at your old employer if they permit that. And that's okay if you like the choices in that retirement plan and you can keep track of it. The problem is it's super easy to forget about it if you just leave it at your old employer. Your third option is to move it to your new employer if they permit those sort of moves. Now, they can make it very seamless for you, a direct transfer. It's very key that the money moves directly from one to the other plan. But they can set that up for you. And if they allow you to do that and you like the options that are in that retirement plan, by all means, that's one way of putting it all together. But the final option, which is what most people are encouraged to do these days, is to roll it over into an individual retirement account or an IRA with a financial institution. Again, they make it super easy for you. They do a direct transfer for you. And this is often really appealing to people because you have all kinds of choices about what you might want to invest in there. You actually control it yourself. You make some of these decisions. And it's kind of empowering in a way. If you have, one thing to remember there is if you have a Roth 401k and you're rolling it over into an IRA, you need to move into a Roth IRA. So that's something to remember there. But here's the one big caveat that Pew Charitable Trust did a study recently that showed that what happens is fees, right? So if you keep your retirement money in an employer fund, it's less expensive in terms of fees than what you're going to pay in your IRA account. And that's because in your individual retirement account in your IRA, you're going to be paying retail fees. And they are able to get the cheaper, less expensive institutional fees. Now, it may not seem like a whole lot of money. These are small differences, but over time, it really can add up. So it doesn't mean you shouldn't roll it over, but it's something to consider.
Carrie, thanks as always for your help and advice. We appreciate it.
Thank you.
Around half of all Americans are planning to make finance-related resolutions in the new year. That's up 36% from a year prior, according to a survey from Wallet Hub. But getting a handle on your money can be daunting, especially for those starting for the first time. So for those who are starting from scratch, but maybe feeling a bit overwhelmed here, we're joined by Tanya Rapley, MyFab Finance founder and financial educator for EarnIn. Tanya, thank you so much for joining us. Certain tips and tricks, Tanya, that you give, and one stood out for me here. An underrated factor, you said, of consistent and positive investing is the discipline in your smaller savings habits. What did you mean by that, Tanya?
Yes, absolutely. So, a lot of people want to know all the tips, all the tricks, or like, what can I do to get ahead? And it really is about your everyday behavior. So when we say your small savings habits, that looks like when you go to the grocery store and you see at the bottom of your receipt that you saved XYZ amount of money. Are you actually putting that in a savings account, or are you actually reallocating it to another expense or spending it on something else and justifying a purchase that you might not have made because you saved actual money? So it is being mindful of your day-to-day habits so that you can get ahead financially. And it starts with, taking step by step by step.
So I'm just thinking of that particular example, because that's not money you've saved, that's money you haven't spent, right? So how do you actually figure out where you can put aside those little pieces of money to then allocate to, savings or what have you?
Yeah, so it is money that you've earned, right? And so ways you can do it, I always recommend that people create an inconvenient savings account. So anything that they are saving, they're putting it out of view from them, so they're not saving the money in their primary banking institution's account. But it is sometimes you have to find ways to bring in additional income. The thing about personal finances is actually pretty simple. You try to make more than you actually spend. And if things are, if they're kind of equal, or you're actually spending more than you're earning, then we have to find ways to bring in additional income so that you can maybe allocate that towards some of your financial goals.
And Tanya, another, for a lot of people listening right now, they've got debt, they have to manage it day to day. How do you avoid getting into a bad debt cycle?
Yeah, so a lot of times people create debt for a few reasons. They're living outside of their means, and so they are living beyond what their finances are enabling them to do. They approach or experience a financial emergency where they kind of have no choice, but it's also because they don't have savings. Or they're also entering in debt because they just had to make a purchase or something like that required them to spend that money. And so what I often recommend people to do is create that savings account, of course, but then also when we're looking at debt and avoiding getting into that cycle of debt, it is taking those cards out of your wallet. It really does require discipline and creating boundaries for yourself, knowing what your triggers are. One of those triggers might be if you go into a store, you're going to spend money, or if you're getting text alerts from the banks that you bank, or not the banks, but the stores that you shop with. And then we need to remove those text alerts from your phone so you're less likely to spend money on your credit card or spend money on things you don't need.
And Tanya, what's your approach to buy now, pay later, which is like sort of taken shopping by storm here? Do you think people should avoid that as well?
I think it depends. Just while some people decide to avoid credit cards, right? It really does depend on your behaviors. Buy now, paid later is not the worst thing that you can do, especially if you need the money. But there are other options such as earned wage access, which allows you to access your money as you earn it. And as a financial educator of Earnin, we found that 82% of Earnin users said that it helped them reduce their financial stress. So that is a viable option.
Tanya Rapley, thank you so much. Really appreciate it. Have a great weekend.
Thank you.
Coming up, what to watch tomorrow. We'll break down the stories you need to know to start your week next week.
Here's what to watch next week. On Monday, Congress will be back in action with a bulging in-tray of issues that need to be addressed. The primary one, of course, being avoiding a government shutdown before January 19th, as deep divides on the border and Ukraine funding continue to slow deal-making.
On Tuesday, Yahoo Finance will kick off its coverage from CES, the biggest tech show on the planet. We'll be bringing you all the best bits from Las Vegas. Expect to hear lots about innovation and, of course, AI. And on Wednesday, all eyes will be on Iowa as the GOP presidential candidates hold another debate. Frontrunner Donald Trump will hold his own town hall on Fox News.
And Thursday markets could get interesting as we get the latest inflation read on the consumer price index. That'll be followed by producer prices a day later. Both will give the street further insight into the Fed's next move following a hot December jobs report.
Also on Friday, we're going to get earnings from JP Morgan Chase, United Health, and Delta Airlines, among others. And we'll be waiting, of course, for any news from the SEC, as many industry watchers expect we might see the first spot Bitcoin ETF approved over the next few days, or could get some incremental movement. We'll see when they actually begin trading. Well, from economic data to earnings, there's a lot ahead for investors to digest next week. On the earnings front, we talked about the big banks on Friday, which everybody tends to get excited about. I am also looking ahead to Jefferies. And those earnings are coming after the close of trading on the 8th, a little bit earlier than the others. Jefferies, an investment bank that is not as much a household name, market cap around $9 billion, but interesting because it's the first to come out, right? And it should give us, ideally, some insight into a lot of the things that we've been talking about, a lot of the questions we have about 2024. If we listen to the call and the outlook, are we going to see deal activity start to pick up this year? Because they all get investment banking fees from that. Are we going to start to get IPO activity pick up? What are we going to hear about in terms of what Jefferies clients are saying? So kind of for that reason, I'm interested in what Jefferies is going to have to say. CEO Rich Handler there longtime CEO, longtime sort of Wall Street operator, if you will, and he's been growing that bank. So it should be an interesting one.
All right, you've got Jeffries. I am interested in CES.
Yes.
Which is a good one for tech investors, but also if you're just interested in tech. This is, of course,
cool stuff.
This is the big tech show in Las Vegas, Sin City. I've covered CES before as a reporter. It is a huge show. And it's not just, you do have the publicly traded companies, but you also have the startups, the newer, smaller companies. It's their chance to kind of show off products and services. In terms of themes, I'd be watching this during generative AI. Certainly, I would expect to hear a lot of that at the show and different companies showing off how they're kind of integrating it across their portfolios. We're going to have people on the ground there kind of helping us distinguish, hopefully, what's real versus what's the marketing fluff, which we tend to hear a lot of as well. And then other big things you can always get at CES, Julie Hyman. You got robotics, always huge, TVs, cars, and maybe this year AR, VR headsets too. Because of course Apple coming in with its new headset. I wonder if that's going to kickstart some interesting conversations
What's
there.
the coolest thing you saw at CES, like in the years when you covered it?
This was years ago.
What stood out to you?
Well, it's kind of shifted because what's in focus has shifted. Like, for example, I think now these days you don't hear as much buzz about smartphone innovation. So it's kind of different than when I was there. But you can still expect the same enormous crowd, for sure.
Lots of cool stuff. Lots of cool video coming from there as well. Well, that'll do it for today's Yahoo Finance Live. Have a great weekend, everybody. Come back Monday at 3 p.m. Eastern. We'll be here for all of your coverage leading up to and after the closing bell.